Let's talk about abolishing the IRS and abolishing income tax at a federal level and replacing it with a 30% national sales tax. So I have here an example. This would be an Iowa tax example. As you can see, this example shows um, the income on a weekly basis for a couple who each make $25 per hour, or they average together $25 per hour. And an annual income that is going to come out to $104,000 per year. So $2,000 weekly gross pay. As you can see here, the federal income tax, the employers are going to withhold $302 a week and send that to the federal government as your federal income tax. And then Iowa is going to get $101 from your gross pay each week. And then your Social Security tax is $124 and your Medicare tax is $29. So your take home pay is going to be $1,444 per week. So when you average that out over the year, or add that all together over the year, you are going to have $15,704 is going to be sent to the federal government as your income tax on your behalf. Now, at the end of the year, when you get your W-2s and you get all of your expenses together and you're ready to file your taxes, which you can do as soon as you get your W-2s, or you can wait as late as April. That's fine, however you want to do it. You are going to record your income and your deductions and your credits, and then you're going to send your tax forms in, and then you will, either get a refund if more was withheld than what you owed, or you'll have to pay more if you actually owe more than what was withheld out of your check. So it's really important to understand what these deductions and credits are. So when you are figuring out your taxes, you have to figure out what deductions do you get. Deductions are things that you had expenses during the year that reduce your total taxable income. So as we said before, this couple made $104,000 over the course of the year. If they have deductible expenses, their taxable income is going to actually be less than $104,000 per year. Some of the examples of that, like if you run a side business and you lose money on your side business, those losses could be deductible. If you are paying student loans, the current tax code allows you to deduct up to $2,500 of student loan interest. Mortgage interest you can deduct. Your local and state taxes that you pay, your property taxes. In Iowa, you can deduct your car registration, I think, as a tax. And then your state income tax also you can deduct from your federal taxable income. So you have those. Now, if you don't have a lot of deductions, they have this really great thing, and it's called a standard deduction. And so for a married couple, the standard deduction right now is $27,700. So this couple who made $104,000 per year, they are actually only going to pay taxes on the $104,000 minus the $27,700. So whatever that comes out to be, I'm not great at math, but so once you figure that out, that number is going to give you your total taxable income. And then based on your tax bracket, it will tell you how much you owe in taxes. Then you look at what are tax credits available to this couple. All right. Well, if they have a child between the age of 0 and 17, they get a $2,000 tax credit. And what a tax credit means is a tax credit is considered like you already paid that amount in taxes. It reduces your taxes dollar for dollar of what you owe. And so other tax credits, there's education tax credits, there's homestead tax credits. I don't know if there still are, but there used to be like first-time home buyer tax credits. There's energy tax credits. So I don't know if they still have them, but at one time, if you put energy efficient windows in your house, you could deduct a certain percent of the cost, or you'd get a credit. Like you paid that much towards your taxes for a certain percentage of that cost. So there's lots of different ways to reduce either the amount of income you get taxed on or the amount of tax you actually have to pay. And so let's say that you're in the 25% tax bracket. So at $104,000 per year, you technically would pay roughly, $25,000 in taxes, a little bit more than that, 25% of $104,000. But with all of the deductions and credits, you're actually going to pay much less than that. And so your effective tax rate is going to be much lower than 25%. And so I'm going to do another video here in a short minute, and that will show you exactly how this works. We're still going to be using the same Iowa couple that is making average between them $25 an hour or an annual income of $104,000 per year. So we have this really great federal tax calculator. It's at AtlanticUnionBank.com. I found it today, and it is pretty awesome. But we are going to be married filing jointly. We are not somebody else's dependents. We are going to say that we have one child. So we're going to put one child in there. We don't have any other children. So our wages, tips, everything from our job, we're going to put in here. We'll just put it like we made it all together. So $104,000. And then these questions you would answer based on whatever was on your W-2s. Income, we're going to say that we don't have any other jobs. We just have, our two jobs where we average $25 an hour. And then we're going to say we don't have a lot of deductions. So we're going to take the standard deduction, which is $27,700. We're going to say we don't have any other taxable income. But right here, you would put, taxable income that it could be, I think maybe like interest from like savings accounts or investments, things like that. We would look, do we have any other tax credits? So it asks you here, child and dependent care credit form. So let's say that we had one child and the child was in daycare, and let's say daycare costs $150 a week. So I have a handy dandy calculator right here. Daycare at $150 a week times 52 weeks is $7,800 for the year. So 7,800. And then it tells you right here, the child dependent care credit limit is $6,000. So you can only take credit for $6,000 of your child care expenses. Certain income ranges can get credits for taking professional development classes or getting a higher education. So we're going to say they don't have any of that. Depending on what kind of retirement account, you could get credits for that. We already get the $2,000 for the child tax credit. They still have residential energy credits. So if you put, energy efficient windows or maybe a new appliance, that might qualify. So there's all these other credits that you get. So what we're going to do here is we're going to hit calculate. And this is going to tell us what our taxable income is. So remember, this couple made $104,000 per year together. They had the standard deduction, which reduced their income $27,700, their taxable income. So their total taxable income was only $76,300. And that means that in their tax bracket, the tax that they owed was $8,719. But because of their child tax credit of $2,000 and their dependent care credit of $6,000, they actually only owe $719 in federal income tax. And so if you remember from earlier, the employer had withheld $304 per week. So over 52 weeks, that was $15,808, but they only owe $719 in tax. So they're actually going to get $15,000 back on their taxes from the federal government. Now, you might wonder, why would the federal government give tax credits for children, or why would they give deductions for home mortgage interest. Well, the reason being, over the years, the federal government wanted to encourage people to have children. They wanted to encourage people to get married. They wanted to encourage people to buy houses. Why would they want to encourage those things? Well, having children keeps the population going. And people owning houses and owning property keeps property values up, and it also keeps crime down, because when people own things, they take better care of it and they look out for it. So those are some of the reasons why the federal government would give tax credits and deductions for certain things that they want to encourage people to do. Now, if you look at what this family maybe has for expenses, I just did rough estimates here. So if this family spends $175 a week on groceries, if they both have to drive to work, they're going to use about maybe 1 tank of gas each, so that's about 40 gallons. At $3 a gallon, 40 gallons of gas is going to be about $120 a week. Winter, you pay more for your heat and electric than summer. So on average, we're looking at $125 in the summer, $250 in the winter, and those are actually what my utility bills are. $75 for water a month. Phone $220 for 2 phones. Internet $65. Subscriptions, I guess I could do without those, but about $150. And then childcare $150 a week. Medical insurance $400 a month. Oh, some of these are a month, but anyway. Rent $2,000, or your house payment $2,000. Car payment, 1 car is paid off. 1 car has a payment of $600. Car insurance for 2 cars is about $2,200 a year. Life insurance is $1,800 a year. And then doing some entertainment, eating out, going to the movies, going to a concert, going to a baseball game, something like that. It's about $400 a month on average. So this family is spending about $76,060 a year on all of their expenses. That's before any kind of emergency or anything comes up. And so, as we just saw when I did the taxes through the way taxes are currently figured with income tax and deductions and credits, the family paid $719 in taxes. But if we abolish the income tax and we go to a consumption tax or a national sales tax, and they have to pay 30% national sales tax on everything that they have to buy, they're actually going to end up paying $22,818 a year in taxes based on all of their monthly expenses. Now, you might say, well, not everything's going to be taxed. But even if this family doesn't pay taxes on what they're buying, the seller or the service provider, whoever they're paying for whatever they're getting, they are going to have to pay taxes on their raw materials or their operational costs. So you're either going to pay 30% sales tax to the government, or you're going to pay increased costs of up to 30% for the goods and services that you have to buy. So either way, you're going, a family of 2 adults and 1 child with an estimated tax bill of $719 a year, they are going to be paying over $20,000 a year either in taxes or increased costs for the goods and services that they have to buy.